reasons is that stability of the economy of that country.
Naturally, that exposes us to quite a lot of different local currencies. How do we handle that?
Borrower or the underlying investment is in another currency.
Welcome back to Kilde Talks Finance. We are here with Radek, our CEO and co-founder, and today we're going to ask him a couple of questions around how we think and how we handle FX, because we have opted for a strategy that goes quite wide. So we like large NBFIs, we like the top 5 NBFIs of specific markets rather than selecting a market and going deep. So naturally that exposes us to quite a lot of different local currencies. How do we handle that?
Very well. Thank you very much for having me again, Johanna. I'm in a summer outfit today.
Contrary to my vest.
Yes. For the listeners who are not familiar with the term, FX means foreign exchange. And generally, we are speaking about foreign exchange risk. Foreign exchange risk means that you invest in one currency, let's say it's a Singapore dollar or US dollar, but the obligation of the borrower or the underlying investment is in another currency, like Indonesian rupiah or Indian rupee and so on. And the currency exchanges between these two currencies, they can work in the favor of the investor or against the investor. Right? So it goes both ways. And then coming to your question, how we actually handling the foreign exchange currencies risk. So the first premise is that we work only in a selected countries. It might look like that we are active in many diverse countries, but actually there's an underlying logic, like why we work in a certain countries and why we don't work in other countries. And one of the underlying reasons is that stability of the economy of that country, current account deficits, current account surpluses, inflation, and those factors, they contribute directly to the exchange rates alongside with the level of interest rate in that local market. So we will be avoiding markets where the currency fluctuations are highly volatile. Right? Yeah, I don't want to mention any specific country, right, but you can imagine some of the countries where it's very volatile. So we are staying away from there. So that's first. Then the second, when we go into these countries where we want to operate and we are aware there's a currency fluctuation. So in risk management, you have a rule of thumb, which is saying whoever has a better means to deal with the risk should deal with the risk. Right? So in our case, we have a lot of smaller investors investing with us, right? And we have a very large corporations who are our borrowers, the NBFIs. Right? Those corporations have 100 million plus usually in their assets, $100 million US plus in the assets. So those corporations are better suited to be handling with the risk because they have a large balance sheets. So this concept is called a risk transfer. So we are transferring the risk actually to the borrower because they are better handling. So we do not bear the risk. Our investors do not bear the foreign exchange risk directly. Right? But if you are very inquisitive, you may be asking yourself, all right, fine, the borrower bears this risk, but what about if this is too much even for the borrower? What if the fluctuation is so large that even them with a large balance sheet, they will be not able to handle that? So here comes our credit team, which is alongside the credit worthiness of the borrower. They are also looking into their financing structure and what proportion of the financing is in the foreign currencies, what was the historical volatility of the local currency, and they are determining and stress testing whether additional exposure giving our investments would somehow tip the scale and make the investment more risky.
And wanted to do a follow-up question on the point you just mentioned previously, that the risk lies with the borrower. But what does that mean? What do they need to do?
So they can decide to engage into the hedging services, and many of the borrowers like do so. They can also decide to bear the risk themselves and bear the volatility. If they do so, then we make sure in the credit assessment and the monitoring that the underlying exposure they have to the foreign currencies does not exceed certain thresholds, which would potentially eat up their margins or put them into the loss, right, and so on. So it doesn't endanger their credit risk profile.
Understood. All right. Thank you very much. And investors on our side, they know from the platform that they can get access to these deals in Singaporean dollars, in US dollars, and sometimes euro as well. Hopefully that answered your questions around how we manage the Forex exposure towards our borrowers. And if you have any other questions for us, please let us know in the comments and we'll answer to them next week. See you later. Thank you very much.
Thank you very much. See you later.